picture this. It's like 3 in the morning.
Oh, man. I know that feeling.
Right. You're just sitting in the dark, bathed in the blue glow of, 6 different monitors.
Yeah, the classic trader setup.
Exactly. And the market opens in a few hours.
Mm-hmm.
Your entire portfolio is on the line. But you just feel entirely hopelessly paralyzed.
Yeah, because there's just too much conflicting information.
Totally. I mean, have you ever felt like understanding the market is this forced choice between two completely conflicting religions?
It really does feel like a religious war sometimes.
It does. On one side of the desk, you have your technical purists. So you're staring at charts, right? You're analyzing order flow, looking for liquidity sweeps and momentum divergences.
Right, the volume profiles and all that.
Yeah, exactly. It's this incredibly rigid world of geometry and price action. But then, and here's the rub on the other side, you have the fundamental disciples.
The macro guys.
Yeah. And there, you're just drowning in macroeconomic data. Obsessing over the yield curve, tracking M2 money supply.
Building out those massive discounted cash flow models.
Oh, don't even get me started on the spreadsheets. You're analyzing sovereign debt issuance, and it's just this heavy world of policy.
And you're just sitting right in the middle of it all.
Exactly. You're sitting in the middle, staring at conflicting data, feeling like you literally have to pledge allegiance to one side just to survive the day.
I mean, it is the ultimate dilemma for anyone trying to navigate financial markets today. You log on to YouTube or, scroll through finance Twitter, and you're presented with this aggressive binary choice.
Like a death match.
It really is. Both sides basically claim to possess the absolute truth, and both sides mock the other constantly.
Oh, the tribalism is so toxic.
It is. But the reality of how capital actually moves through the global financial system is, it's just far more complex than a simple binary choice.
Which is exactly why we're doing this. Welcome to this deep dive, everyone. Today, our mission is simple, but it's massive.
I'll have a lot of ground to cover.
We really do, because we are going to dismantle this false divide between technical and fundamental analysis. We're going to expose the actual mechanical reasons why these methods fail you, when they are used incorrectly.
And they are used incorrectly almost all the time.
Right. And then we are going to rebuild a completely new framework for observing how markets genuinely operate.
Yeah.
We're stripping away the tribalism completely.
I love that. Let's get into it.
Okay, let's unpack this. Let's start by looking at the current landscape. Market analysis is almost universally framed as this binary choice.
Technicals versus fundamental.
Exactly. Technical analysis, which focuses purely on price, structure, historical patterns, versus fundamental analysis, which is all about macro regime conditions and economic data.
Right.
But why is the tribalism so incredibly toxic? Like, why do we see people building their entire identities around just one of these methods?
Well, I think the tribalism exists because human beings just fundamentally crave certainty,
For sure. We hate not knowing.
Exactly. And financial markets, by their very nature, are just these massive engines of pure uncertainty.
It's just chaos.
Absolute chaos. So when you introduce the kind of extreme financial risk that comes with trading and investing, the human brain literally panics.
It looks for a lifeline.
Right. People look for a rigid belief system to anchor themselves. They need a dogma. So what happens is you end up with 3 very distinct, very entrenched camps of market participants.
Okay, break those down for me. What's the first camp?
First, you have the purists who reject fundamentals entirely. They completely ignore the news.
Right, the price pays crowd.
Exactly. They only look at the tape. They only look at charts. Their entire mantra is price pays.
I hear that constantly, the whole, price is truth argument.
Yeah.
They argue that every whisper from the Federal Reserve is already magically on the chart.
That is their core belief.
Yeah.
They argue that all known information, all human emotion, all institutional repositioning,
Literally everything,
even forward-looking economic data, they think it's all magically and instantaneously priced into the candlestick right in front of them.
It's a bold claim.
It really is. So to this camp, reading an inflation report or modeling a corporate balance sheet is just a profound waste of time. They believe the chart is this omniscient ledger of human behavior.
Right. Okay, so then you have the second camp, which is on the complete opposite end of the spectrum.
The macro purists.
Yeah, the fundamental zealots. I know these guys. These are the participants who dismiss technical analysis as complete noise.
Oh, they hate charts.
They despise them. To them, drawing a trend line on a chart is indistinguishable from, like reading tea leaves or consulting astrology.
Yeah, voodoo math.
Exactly, voodoo math. They only care about the heavy machinery of the global economy. They're building these incredibly complex spreadsheets, modeling out interest rate trajectories.
Projecting forward corporate earnings based on shifting gross domestic product inputs.
Right. And they operate on this massive assumption that the market is a perfectly rational weighing machine. They really believe that if they just get the math right, the market will eventually have to bend to their rational conclusion.
Which, spoiler alert, it often doesn't.
No, it rarely does.
Yeah.
And then there is the third camp, the people caught in the crossfire.
Yeah, this is the most common one.
Right. The ones who know enough to realize that ignoring half the data is just a terrible idea, but they have absolutely no idea how to merge them.
I call them the confused middle. This is honestly where the vast majority of retail participants live.
And even a lot of struggling professionals,
Well,
honestly.
absolutely. They try to combine both approaches because they hear, you should use fundamentals and technicals, but they lack any kind of structural hierarchy for actually doing it.
Right. There's no system.
No system at all. So what happens? They end up with completely conflicting signals.
Oh, I've been there. Your discounted cash flow model says the asset is drastically undervalued.
So it's screaming, buy immediately.
Right. But then you pull up the chart, and it's in a relentless, brutal downtrend, just screaming at you to sell.
And the conflict paralyzes them. This leads to endless confusion, massive drawdowns in their accounts, and total psychological burnout.
It's exhausting. Let me throw an analogy at you to kind of frame how absurd this divide really is.
Yeah, go for it.
So, is this like trying to understand a massive turbulent ocean by only looking at the violent waves crashing on the surface? Which, that would be your technicals, right?
Right, the immediate surface action.
Yeah, exactly. Versus only looking at the gravitational pull of the moon, which would be your fundamentals. I mean, think about the actual mechanics of sailing.
You can't sail with just one of those.
You really can't. You cannot navigate a ship safely across the Atlantic by choosing just one of those data points. If you only look at the moon, you know the tide is coming in, sure.
But a 40-foot rogue wave will still capsize you today.
Exactly. And conversely, if you only look at the waves, you might survive the storm today, but the receding tide will strand your ship on a sandbar tomorrow.
That's a perfect way to look at it.
So why do we treat these as competing explanations when they clearly describe entirely different mechanical realities?
Because people are dogmatic. But that analogy perfectly captures the absurdity of the debate. You literally cannot sail a ship by ignoring the water directly in front of you.
Obviously.
Nor can you sail it by ignoring the larger celestial mechanics that are dictating the tides over time. Treating technicals and fundamentals as interchangeable tools creates the ultimate trap in market analysis.
It's comparing apples to, like, submarines.
Right. That is the foundational error we have to correct today. They are not opposing frameworks. They are just partial views of a much larger process.
Like the blind man and the elephant.
Exactly like that. They do not operate on the same conceptual level. They don't even describe the same phenomena.
And when you treat a partial view as the complete truth, you just blind yourself to reality.
You do. You miss the big picture entirely.
Okay, so let's dismantle these partial views. Let's start with the anatomy of technical analysis. Let's define the mechanical reality of what this tool actually does.
Sure.
Technical analysis focuses entirely on price action, right? It observes how price moves, how it reacts to specific liquidity zones, and how it forms structures over time.
Yeah. We're talking about the mechanics of trends, ranges, volume profiles, and momentum.
Right. And we definitely must give credit where it's due.
Oh, absolutely. We have to acknowledge the absolute greatest strength of technical analysis, which is its immediacy.
Immediacy. Okay, expand on that.
Well, price is constantly updating. Millisecond by millisecond, the price feed is processing real-world transactions. So it reflects the exact current state of the market's execution.
There's no delay.
None at all. There is no lag. There's no waiting for, the Bureau of Labor Statistics to publish a revised jobs report 3 months after the fact.
Right, which is always backwards looking.
Always. Because of this hyperimmediacy, technical analysis is the ultimate, unrivaled tool for execution, period.
Because it gives you a highly specific mathematical way to define your entry into a market, right?
Exactly. It defines your entry, your exit, and most importantly, your risk threshold.
Right. You can point to a specific price level on the chart and define your invalidation point.
You can literally say, if the price drops below this specific liquidity pool, my thesis is mathematically wrong and I am cutting the trade.
It's extremely precise. But And here's the massive vulnerability that the price pays crowd completely ignores.
Hmm.
We are looking at the immediate outcome, but we're completely blind to the cause.
Yes, that is the fatal flaw.
Right. Technical analysis is purely descriptive. It shows you exactly what is happening on the tape right now, but it tells you absolutely nothing about why it is happening.
That is the blind spot. Let's look at a specific mechanical scenario to illustrate how dangerous this actually is in practice.
Okay, lay it out.
Imagine you're staring at a chart. You see a massive, violent price breakout. I mean, the price rips right through a major resistance level on high relative volume.
A beautiful chart.
Spectacular. From a purely technical standpoint, it looks incredible. It's a textbook breakout. Every single momentum algorithm out there is flashing green.
Right.
But the chart itself cannot tell you the underlying quality of that breakout.
Wait, explain what you mean by the quality of the breakout. Isn't price just price?
Not at all. Not when it comes to predicting follow-through. The mechanics behind the price action matter immensely.
Okay.
The chart cannot tell you if that price surge is fueled by, say, long-term structural capital flowing into the asset. Money from sovereign wealth funds and massive pension programs taking a 5-year position.
All right, the heavy hitters.
Exactly. If it is structural capital, that trend will last. It has fuel. But what if it isn't?
What else could it be?
What if that exact same price movement is just a temporary, fleeting burst of short covering? What if it's just a dealer gamma squeeze in the options market that is going to completely evaporate by tomorrow morning?
Oh, wow. And the chart looks the exact same.
The geometric structure on the chart looks completely identical in both scenarios.
That is terrifying when you stop and think about the mechanics of risk. You're putting your real capital on the line based on a shape.
Just the shape.
This really highlights the incredible danger of relying purely on historical repetition. Traders see a pattern, right? They see a head and shoulders or a bull flag or a moving average crossover.
Just classics.
Yeah, and they assume that because that geometric shape preceded a rally in 2018, it will absolutely trigger a rally today.
Which is incredibly naive.
It is, because technicals capture human behavior. They capture the footprint of the capital. They do not capture the underlying cause of that behavior.
Exactly.
So what does this all mean? It means you are driving down a winding highway at 100 miles an hour by exclusively staring into the rearview mirror.
That is a scary visual, but it's accurate.
Right. You know exactly where you just were. You have a perfect record of your historical path. But you have zero idea if there's a massive brick wall 10 feet in front of your bumper.
None. You are relying on historical structure to predict a future outcome without understanding the present incentive that is actually driving the capital.
Right. And that brings us to the complete opposite end of the analytical spectrum.
Yes, the macro side.
Right. Because if technical analysis is entirely obsessed with the what, fundamental analysis is entirely obsessed with the why. Let's shift gears to that fundamental side.
Let's do it.
Fundamental analysis is looking at the big, heavy tectonic forces influencing asset prices, right?
The structural gravity.
Exactly. We're talking about the mechanics of interest rates.
Yeah.
We're talking about structural inflation regimes.
Central bank balance sheet expansion or contraction. Gross domestic product growth. Geopolitical supply chain disruptions.
Yeah, these are the massive gears turning deep beneath the surface of the global economy.
They are. And the absolute greatest strength of fundamental analysis is explanation.
It gives you the why.
It provides this incredibly powerful logical narrative. When you do the deep fundamental work, you can identify the underlying incentives for why massive pools of capital should move in a certain direction.
Right. You understand the structural forces at play.
You understand the long-term value proposition. For instance, if you analyze a commodity market and you see a massive multi-year supply deficit forming while demand is structurally increasing.
You found the fundamental gravity.
Exactly. You found the gravity. It gives profound logical context to broad market behavior over the long run.
But, and this is huge, but the fundamental camp has a massive, glaring blind spot of its own.
A huge one.
It is the reason so many brilliant Ivy League economists make terrible, terrible traders.
Oh, the worst traders.
Right. Fundamentals have absolutely zero sense of timing. None whatsoever.
That's the tragic truth. They cannot tell you when a move will actually start. They cannot tell you how it is going to unfold day to day.
And they certainly cannot tell you when it is going to exhaust itself.
No, they can't. And this leads to the classic agonizing trader's nightmare. We see this play out cycle after cycle.
Oh, tell me the nightmare.
Okay, so you sit down, you do the hard work, You dig through the sovereign debt data. You analyze the M2 money supply. You identify the absolute perfect macroeconomic narrative.
You're doing the real homework.
Exactly. Let's use a real-world parallel here. Let's say it's early 2021, and you realize that structural inflation is going to surge long before the central banks are willing to admit it.
Because transitory.
Right, everyone's saying transitory, but you see the supply chain bottlenecks. You see the unprecedented fiscal stimulus.
You have the receipts.
You are completely right about the economy. Your spreadsheet is flawless. Your logical deduction is airtight, so you short the bond market.
A completely rational move.
Yes, but the market completely ignores you.
Oh, this is the worst feeling in the world when, in your bonds that you are right, but your P&L is just bleeding out every day.
It is psychological torture. You act on your fundamental thesis, you put the trade on, but because fundamentals have no timing mechanism, you acted too early.
Way too early.
The market continues its irrational momentum against your position. So, what happens? You start facing margin calls.
Bleeding out.
You bleed premium if you're using options. You eventually run out of capital, or honestly, the psychological pain just becomes too great and you capitulate.
You close the position at a massive loss.
You do. And then, and this is the kicker, 6 months later, the central banks finally panic. The market finally wakes up.
And the asset moves precisely as your fundamental model predicted.
Exactly as predicted. You were 100% right on the macroeconomic narrative, and you still lost your entire account.
You were intellectually vindicated and financially ruined.
Yeah, you get to be the smartest person in the bankruptcy court.
Which is just a tragic place to be.
What's really fascinating here is that a strong macro case does not equal immediate price movement. The transmission mechanism takes time.
Right, it's not a light switch.
No, there is a massive, highly variable delay. Markets can completely disconnect from fundamental logic for agonizingly long periods.
Like they say, the market can remain irrational far longer than you can remain solvent.
Exactly. The mechanics of capital flow are messy. Fundamentals explain the underlying why, but they fail completely at pinpointing the when or the how.
Right. Let's zoom out for a second. We really need to address why these tools feel so deceptively complete when people use them in isolation. Like, why do people get so emotionally trapped in these camps?
That's a great question.
I think it really comes down to deconstructing the pure arrogance of both sides.
Arrogance is the perfect word for it. Let's start by examining the arrogance of the technical trader.
Do it.
The technical trader operates on the assumption that price contains all information. Therefore, they think studying the geometric structure of the chart is all that matters.
Right.
But the profound arrogance is believing that structure has any meaning whatsoever without context.
Because context is everything.
Exactly. The exact same chart pattern behaves violently differently depending on the macro environment it is literally born into.
Okay, give me an example.
Let's take a standard breakout from a consolidation range. A technical breakout in an environment of expanding central bank liquidity and falling interest rates. That is a... It has actual fuel behind it.
Okay, but what about the flip side?
Well, what if that exact same geometric breakout pattern occurs in an environment of contracting liquidity and aggressively rising rates?
Oh, it's a whole different game.
That is a textbook bull trap. It's not a real breakout. It's a liquidity grab by larger players looking to exit their positions before the market rolls over.
So the shape is the same, but the outcome is opposite.
Right. The macro context dictates the outcome of the technical structure.
So the chart purists get slaughtered because they bought the shape without checking the weather, basically.
Exactly.
And the fundamental trader is just as arrogant, aren't they?
Oh, without question. The fundamental trader suffers from the arrogance of academic certainty.
Academic certainty. I love that phrase.
It's true. They believe that macro drives everything, and therefore their math is destiny.
Right. I solved the equation, so the market owes me money.
Exactly. But the translation from macro data to actual market price is never, ever a straight line.
It's messy.
It is incredibly messy. It is routed through human emotion. institutional mandates, algorithmic execution, complex derivatives positioning.
So being right on the fundamental direction is completely useless if your timing and your structural positioning are wrong.
Completely useless. You can be mathematically correct that a specific sector is fundamentally undervalued based on, earnings multiples.
Right, the PE ratio looks amazing.
But if massive institutional capital is structurally forced to liquidate that entire sector due to external margin calls or changing regulatory mandates,
The price is going down.
the price is going to keep falling regardless of how attractive that PE ratio looks.
Okay, so I know a lot of listeners are probably thinking, fine, I see the flaws in both. I won't be arrogant. I will just be the smart person who uses both.
Ah, yes.
Which brings us to what you call the combination trap. People say, I will use fundamentals to form my big picture view, and then I will just use technicals to confirm it and time my entry.
Which sounds great, right?
Well, wait, let me play devil's advocate here.
Mhm.
That sounds completely logical on paper. Why doesn't that work? Why is that a trap?
Because combining them without a strict mechanical hierarchy just creates completely conflicting signals.
Yeah.
You're basically taking two entirely different languages and trying to read them simultaneously.
Okay.
Think about the actual mechanics of this in practice. You develop a bullish fundamental narrative. The economic data clearly says this asset should go up.
The spreadsheet says buy.
Right. So you pull up the chart to confirm your bias, but the price structure is collapsing. It's slicing through major support levels. The chart is screaming at you to sell.
Oh, man.
What do you do mechanically in that moment?
Honestly,
Mm-hmm.
you freeze. You just stare at the screen and you do absolutely nothing.
You freeze, or even worse, you abandon any semblance of a system entirely.
Yeah, because you're stressed.
Exactly. When the macro narrative says buy, but the price action says sell, the lack of a structured hierarchy just destroys your ability to make a rational decision.
You just end up guessing.
You end up cherry-picking the data that fits your current emotional state. If you are feeling greedy and you just really want to buy, you ignore the terrible chart and blindly trust your fundamental model.
The chart is lying, right?
Right. And if you're feeling fearful, you ignore the fantastic fundamental data and trust the collapsing chart.
So the combination of the two isn't actually the problem.
No, the lack of a structured system for applying them is the problem. You are just introducing more complex variables without a mechanism to resolve the inevitable conflicts between them.
That makes total sense.
Mm-hmm.
We're trying to mix oil and water without an emulsifier. We're just making a mess. So let's take the listener into the danger zones. Let's stress test this theory. When do the limitations of both of these frameworks become absolutely impossible to ignore?
Well, if you study market history, there are three specific recurring market phases where both frameworks completely break down if you don't understand how they interact with each other.
Okay, let's hit the first danger zone. Transitional environments. Explain the mechanics of what happens here.
A transitional environment is basically a macroeconomic regime change. The old narrative that drove the market for the last cycle is dying.
Okay.
And the new narrative isn't mathematically clear yet. Think about a massive shift like moving from a decade of zero interest rates and quantitative easing suddenly into an environment of persistent, sticky inflation and aggressive rate hikes.
Oh, like what we saw recently.
Exactly. During this transition, the fundamental data is a completely contradictory mess. One day you get a shockingly hot inflation print, and the market panics. The very next day, you get a terrible jobs report suggesting a recession. The fundamental trader is totally lost because the narrative literally changes every Tuesday.
And what is happening to the chart reader during this macro transition? How is their tape reacting?
The price structure goes absolutely haywire. Because the macro narrative is confused, institutional capital is confused.
Money is just flying around.
Money is violently rotating in and out of different sectors trying to find a safe harbor. Breakouts fail constantly.
Because there's no conviction.
Right. Major support levels shatter, only to immediately reverse into massive short squeezes. Volatility spikes across the board.
So the technical trader is getting chopped to pieces.
They are dying by 1,000 cuts. The geometric patterns that worked flawlessly for the last 5 years suddenly just stop working.
Because the underlying regime changed.
Exactly. Both the chart reader and the macro reader are taking massive losses because they are relying on tools that assume a stable, trending environment.
Wow. Okay, that brings us to phase 2, late-stage markets. This is fascinating to me because this is the phase where everyone on financial Twitter thinks they are an absolute genius, right before the floor falls out.
That is the defining characteristic of a late-stage market. Everyone is making money on paper.
Right.
In this phase, the fundamental narrative is still technically true. The economic data might still look absolutely fantastic.
Like corporate earnings are beating expectations.
Exactly. GDP is expanding. So the fundamental trader looks at their spreadsheet and continues aggressively buying,
What?
but the price action just stops responding.
Mechanically, why does it stop? If the news is objectively good, why doesn't capital flow to the goodness?
Because of the mechanics of market positioning, everyone who is going to buy has already bought.
Oh, I see.
The trade is completely crowded. Institutional allocation is basically maxed out. Momentum dies because there is simply no marginal buyer left to push the price higher.
They ran out of money.
Exactly. But here's the trap. Technical analysis often misreads this dying momentum. The chart reader sees the price consolidating sideways near the highs, and they interpret it as a simple continuation pattern.
Like a bull flag.
Right, a bull flag. It looks like a brief pause before another massive leg up. Meanwhile, fundamental analysis is screaming in confusion as to why the market isn't rocketing higher on this amazing earnings beat.
They're both confused for different reasons.
Exactly. They both fail to see that the actual process of capital deployment is exhaustive.
It's like throwing high-quality wood onto a massive bonfire, but there is literally no oxygen left in the room. The wood is good.
Yeah.
The fundamental data is good.
Yeah,
But the fire will not burn.
that's a great analogy.
All right, let's look at phase 3, high-impact events.
These are the sudden, violent, exogenous shocks.
Give me some examples.
A geopolitical crisis breaking out over a weekend. A surprise central bank intervention that was not telegraphed to the market. A massive systemic corporate fraud coming to light.
Total black swan territory.
Exactly. In these specific moments, historical price levels are destroyed instantly. A technical support level that held perfectly for 2 years is sliced through in 3 seconds by algorithmic selling.
The chart is completely broken.
The technicals are completely invalidated, and meanwhile, fundamental data cannot update fast enough to save you.
Right, because macro is slow.
You cannot wait for the next quarterly GDP report to be published to tell you how to manage your risk during a sudden global liquidity crisis.
So in all three of these specific recurring danger zones, both pure approaches fail spectacularly.
They do. And if we connect this to the bigger picture, both pure approaches fail in these zones because they rely on static input.
Static inputs.
Yeah. The technical trader relies on a fixed, static geometric pattern. The fundamental trader relies on a printed, static economic number.
But the market isn't static.
Exactly. The market itself is not static. The market is a living, breathing, incredibly dynamic entity. It is an evolving ecosystem.
But the real story is, there is a grand unifying theory that both of these warring tribes are completely missing.
There is.
There's a missing layer that connects the fundamental moon to the technical ocean. And that missing layer is the process, capital flow. Let's dig into the actual mechanics of this.
This is the paradigm shift that separates the amateurs from the professionals.
Okay, break it down.
Markets do not move because a data report was published on a government website. They do not move because a geometric triangle formed on a chart.
Right, those are just representation.
Exactly. Those are abstract representations of reality. Markets move for one mechanical reason and one reason only. Capital responds to inputs over time.
Money actually has to change hands. Billions of dollars have to literally be routed through brokerages and prime dealers.
Yes. And the journey of that institutional capital is never instant. It is a complex mechanical process.
Explain how that works for the big guys.
Think about a massive pension fund that needs to deploy $10 billion into a specific sector. They cannot just click a button and buy it all at once.
Right, they buy up the whole order book.
They would destroy the order book and drive the price up against themselves. They'd ruin their own trade. So they have to use execution algorithms like VWAP volume weighted average price.
They have to hide their footprint.
Exactly. They have to slowly accumulate over weeks or even months. And this creates a process.
A cycle.
It builds slowly as the smart money quietly positions themselves. Then it expands aggressively as the broader market catches on and momentum algorithms ignite.
Right, the markup phase.
Then it slows down as everyone gets in and the trade becomes crowded. And eventually, the smart money distributes their holdings to the latecomers and the trend reverses.
They sell to the retail guys.
Exactly. This progression, this mechanical life cycle of capital flow, is the missing layer in almost everyone's analysis.
Let me try to visualize the mechanics of this process because I think I have another analogy.
Let's hear it.
It's like a massive stadium concert.
Okay.
The fundamentals, the macro narrative. That is, the band announcing a massive, highly anticipated world tour. That is the incentive. That is the logical reason why people want to go.
Right, the fundamental draw.
Exactly. The
Okay.
technicals, the charts, those are the aerial photos of the crowded stadium taken on the night of the show. That is the final outcome.
The snapshot.
Right. But the process, the actual capital flow, is the entire 6-month mechanical journey in between those two things.
Yes.
It's the flow of the most dedicated fans slowly logging online during the presale. It's the ticket scalpers stepping in to drive up the secondary market price. It's the casual fans experiencing FOMO and paying a huge premium.
And then the actual physical movement.
Right, it's the crowd physically lining up outside the gates, rushing the stage, and eventually getting exhausted and going home. If you only look at the tour announcement, you don't know if the venue is completely empty.
And if you only look at the photo of the packed crowd.
You don't know that the concert is ending in 5 minutes and everyone is about to head for the exits. You have to track the flow of the people. You have to track the capital.
That is a phenomenal way to frame it. Fundamentals create the incentive. Technicals reflect the outcome.
Right.
But neither of those tools captures the actual path from cause to effect. That path is dictated by liquidity cycles, by distinct phases of accumulation and distribution, and by shifting market participation.
You have to ask who is buying right now.
Exactly. Are they long-term holders or short-term speculators? Are they rushing the stage, or are the VIPs already quietly heading for the exits?
Right.
If you do not understand the mechanical process of capital flow, you are just guessing at static snapshots.
Now here's where it gets interesting. We are not throwing these traditional tools away.
No, definitely not.
If you're a listener who has spent 5 years studying macro data or 5 years learning volume profile and chart patterns, do not panic. We are just drastically changing how we apply them.
We are reframing the tools to actually fit reality.
Let's start with reframing technical analysis. How do we do that?
The very first step is a psychological reset. You have to stop using charts as magical prediction signals. A chart absolutely does not predict the future.
So what are we actually doing with them? If they don't predict, what is their function?
You start using them as a diagnostic tool. You use them to observe how the market is mechanically responding to reality.
Okay.
Structure is not a prediction. Structure is just an expression of underlying capital flow. It is the footprint of liquidity.
Let's go back to that breakout example from earlier.
Sure. If a massive breakout occurs and the price holds that new level, that is not a magic signal telling you the future.
Right.
That is concrete, mechanical evidence of real participation. It means institutional capital is actually flowing in, absorbing the selling pressure, and supporting higher prices.
But if it fails?
Conversely, if the breakout fails and the price collapses back into the range, that is evidence of a lack of belief.
It faked out.
Exactly. It shows that there was no real structural capital flow behind the move. It was just a liquidity grab.
It completely shifts your psychology, shifts you from trying to arrogantly predict the future to actively, humbly interpreting the present.
Humbly is the key word.
You're no longer saying, this wedge pattern guarantees the market will go up. You are saying, this consolidation shows me that capital is currently absorbing supply, and I will just wait for the breakout to confirm the flow.
It takes the ego completely out of the equation.
Which is huge for trading.
It forces you to be objective.
Yeah.
And we have to reframe fundamental analysis in the exact same objective way.
How do we do that?
You have to stop using macro data to predict exactly what the S&P 500 will do tomorrow morning at 9:30 a.m.
Because it mechanically cannot do that. The gears are just too big.
Right. Instead, you start using fundamental analysis to understand the incentives of big money.
Okay, the why.
Exactly. Fundamentals provide the macroeconomic backdrop. They set the stage. They tell you why massive institutional capital might want to accumulate a certain asset over the next 12 to 18 months.
They define the structural gravity we talked about.
Yes, but the fundamental data absolutely does not dictate the timing of the play.
Let's do a quick check-in on this concept because it is so crucial for anyone listening.
It's the core of everything.
By shifting your mindset this way, you stop forcing these tools to do jobs that they were never mechanically designed to do.
Right.
You stop asking a geometric chart to explain sticky inflation dynamics, and you stop asking a CPI report to tell you exactly what minute to buy a stock. You let them do what they're actually good at.
And when you finally do that, the paralyzing conflict we talked about at the beginning of the discussion entirely disappears.
It just evaporates. Which brings us to the ultimate question. How do we actually put this all together? How do we synthesize the macro gears, the capital flow, and the price action into a working mechanical model?
This is where we introduce campaign logic.
Yes, Section 8, campaign logic. This is the grand integration.
The blueprint.
Exactly. This is how we take the gravitational moon, the ocean waves, the concert tickets, and turn it all into a replicable system. So what exactly is campaign logic?
Well, campaign is a master structure that accounts for the entire process of capital flow. We use the word campaign very deliberately rather than the word trade.
Why is that distinction important?
A trade implies a single, isolated, almost random event. You enter, you exit.
Like pulling a lever on a slot machine.
Right. But a campaign implies a prolonged strategic effort with multiple distinct phases of development. It defines a strict mechanical hierarchy so that your technical indicators and your fundamental models never fight each other again.
Let's break down this hierarchy. I really want the listeners to visualize this blueprint. Step 1 in the hierarchy, fundamentals.
Step 1, fundamentals equal the incentive.
Okay.
This is the why. Before you ever look at a chart, before you even pull up a moving average, you define why a massive move might happen in the first place. What is the macro backdrop?
Give me a real-world case study to anchor this.
Let's look at the copper market.
Oh, good one.
Your fundamental analysis reveals a massive structural supply deficit forming over the next 5 years due to, electrification and a severe lack of new mining projects.
Right. Everyone needs copper for EVs, but no one is digging new holes.
Exactly. That is your why. You are defining the fundamental gravity that will inevitably pull capital toward copper.
Okay, so we have the why, we have the gravity, but we don't buy yet.
Absolutely not.
We move to step 2 in the hierarchy, the campaign itself.
Step 2. The campaign equals the process. This is the how.
Break down the how.
This tracks how the capital flow actually develops through its natural life cycle. You are actively mapping out the mechanical phases.
You're asking where we are in the story.
Exactly. Is the copper market currently in the early accumulation phase, where smart money is quietly buying up mining stocks while the price is still flat?
Oh.
Or is it in the markup phase where the trend is obvious, the news is catching on, and momentum algorithms are just jumping in?
The feeding frenzy.
Right. Or is it in the exhaustion phase where the fundamental supply deficit narrative still sounds completely amazing on CNBC, but the actual capital flow has completely dried up and the smart money is busy distributing to retail?
You have to know what phase you're in.
You have to identify exactly where you are in the life cycle of the campaign.
Wait, let me push back on this a little bit.
Sure.
How is identifying a campaign phase any different from just running a technical stock screener with a fundamental filter? That sounds dangerously close to the combination trap you just criticized earlier.
That is a great distinction to make. A simple filter just looks at static data.
Right.
It says, show me stocks with a low PE ratio that are currently trading above their 200-day moving average. That is a snapshot.
It's just 2 points in time.
Exactly.
Right.
Campaign logic requires you to analyze the transition of volume and liquidity over time.
The transition.
Yes. You aren't just looking for a moving average crossover. You are looking at the volume profile over months to see if larger institutions are actively building a base.
You're watching the behavior.
You are tracking the shifting behavior of the participants.
Right.
It is highly dynamic, not static.
Okay, I see. You're literally tracking the footprint of the accumulation as it happens.
Yes.
And finally, step 3 in the hierarchy. Technicals.
Step 3. Technicals equal the execution. This is the when.
The final piece of the puzzle.
Exactly. Once you know the why from your fundamental supply thesis, and you know the how from tracking the accumulation process in the campaign phase, then and only then do you use technicals.
They're the trigger.
They provide the hyper-specific mathematical tools to actually enter the market.
So you define your entry trigger.
Yes. Perhaps a breakout of a multi-month accumulation range on high volume.
And you define your risk.
You mathematically define your risk, placing your stop loss right below the liquidity pool that invalidates the breakout.
And you define your exit.
Exactly. And all of this is based entirely on observed real-time market behavior.
Wow.
And this raises an important question. How much psychological stress is removed from your life when you actually adopt this mechanical hierarchy?
Oh, it has to be night and day. I mean, think about the paralysis we talked about at the very beginning of the deep dive. Staring at the screens at 3 a.m., sweating over conflicting data.
It's awful. But in a campaign structure, every single component has a specific limited job. No tool is asked to be omnipotent.
Right. The macro data gives you the thesis, the campaign tracks the institutional flow, the chart gives you the precise entry and the risk parameters.
And the conflict completely vanishes.
It's a clean assembly line.
The psychological relief is immense. Because you are no longer demanding perfection from flawed tools, you are just using them as a cohesive, integrated system.
Think about our combination trap scenario again. If your copper fundamental say buy, but your technical execution layer is breaking down and slicing through support.
You do not freeze in a panic.
No, you just consult the hierarchy.
Right. The execution layer is mechanically telling you that the current capital flow does not yet support the fundamental thesis.
So what do? You don't enter.
There is no emotional conflict. You simply wait. You are aligning the underlying incentive, the mechanical process, and the precise execution.
It is brilliant. It is a completely different way of interacting with the market.
It changes everything.
So let's bring this all together. We started today with this toxic forced choice, this religious war between the chart-reading purists and the macroeconomic modelers.
The false binary.
Exactly. But we've seen that relying purely on technicals shows you market behavior without giving you the underlying cause.
You're driving in the rearview mirror.
Right. And relying purely on fundamentals shows you the underlying cause without giving you the timing mechanism.
You're right, but you're broke.
Precisely. The mistake was never the tools themselves. The mistake was expecting a hammer to act like a screwdriver and then getting furious when you couldn't screw in a nail with it.
That's exactly it. And as we look to the future, this kind of structural integration is only going to become more critical for survival.
Because the game is getting harder.
Markets are becoming exponentially more complex every single day. Information moves at the literal speed of light now. High-frequency algorithmic trading amplifies volatility and creates all sorts of false technical signals.
Right. And you have massive passive inflows distorting fundamental valuations.
Exactly. So the traders and investors who actually survive and thrive over the next decade, they will not be the ones rigidly defending one pure, outdated ideology.
The purists are just going to get run over by the machines.
They absolutely will be crushed. The survivors will be the integrators.
I love that term, the integrators.
They will be the participants who deeply, mechanically understand that markets are living, breathing processes of capital responding to changing economic conditions over time.
So it's not about finding a magic bullet.
No. Mastery in this space is no longer about finding the perfect magic indicator or the ultimate proprietary data feed. Mastery is about deeply understanding how the mechanical pieces fit together into a cohesive whole.
That is incredibly powerful. So I want to leave you, the listener, with a final lingering question to just sort of ponder on your own as you look at your screens tomorrow morning. We talked today about how the traditional X-ray machine of market diagnosis is broken and how we really need to look at the process of capital flow instead. So if every single geometric technical pattern on a chart is really just a footprint of institutional capital,
Yes.
and every fundamental data point is just a macro incentive for that capital to move, where is a capital in your own specific industry flowing right now?
That's the real question.
And when you try to understand it, are you actually analyzing the cause or are you just staring blankly at the footprints?